Hello, chart watchers, and welcome to this Wednesday, February 13th, 2019 Market Watchers Live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, another day and another day of gains. We've got the Dow Jones Industrial Average currently up 111 points, the S&P 500 up 8.5, the NASDAQ up 13, the Russell 2000 up fractionally. It's been kind of tossing back and forth between positive, negative territory, is up fractionally right now. 10-year Treasury yield did move up above the 20-day moving average. We'll talk about that in just a minute. It is still up a little bit more than 1 basis point to around the 270 level. Volatility index continues to drift lower, which is bullish for equities. Energy leading the action to the upside, up more than 1%, actually almost 1.5%. Financials also having a pretty good day. On the flip side, we have utilities pulling back now with the 10-year Treasury yield beginning to rise a bit. Goldman Sachs leading the financials to the upside and also leading the Dow up more than $2 today. Cisco, the worst performer in the Dow, and Cisco actually does report after the bell today, down 1.25% before its earnings report. And I was looking at the scooter movers, and Groupon takes the prize for the biggest scooter mover to the downside today after it reported its earnings last night. Stock, you can see, down more than 13% today. Huge drop in the scooter. Groupon down now to $3.42. All right, Erin, it is hump day. Market just keeps putting its head down, charging forward. What do you think?
Indeed, it does. It's very interesting to watch this market action to the upside. Of course, I've been quite bearish. I'm still very bearish, but yeah, you know, it's good to see it moving back up. I suspect it's going to get overbought here pretty soon, though.
Yeah, well, I know the S&P 500, you know, is getting closer and closer to those key tops back toward the end of 2018. So we'll have to see whether or not we can negotiate that. It's been impressive watching the market make a move up, you know, throughout over the last 7 weeks or so, taking out one resistance level after another. But there are still overhead resistance levels. Market still has issues to deal with. And so just take it one day at a time, see how the technicals evolve, no doubt.
Yep.
We do have a special guest, though, with us today, Rick Bensignor, in the No Trader. Rick, how are you doing today?
I'm good. Thanks for having me back, guys.
It's always a pleasure to have you on here. I'm really interested. I know that you take a little different approach to the market, and I think sometimes like to buy when everyone else is selling and selling when everyone else is buying, and sounds a lot like Warren Buffett to me.
Well, I like to come from the idea of buy low, sell high.
Yeah, that's always a good area to come from, no doubt about it, especially if your goal was to make money. Certainly makes sense. But I know you're in here for 30 minutes with us today. You got some great information for all of our listeners, and really looking forward to your presentation. So we're going to have you back in about 15 minutes or so, if that's all right.
Great, thanks.
Perfect. All right, Erin, I know we got a busy lineup set, and I can't wait to get Rick's presentation started. So why don't we go ahead and get going?
Excellent. So tomorrow is going to be our Valentine's Day special. We are actually asking you what Bill Shelby, who will be coming on, should cover in our poll today. So go take that poll. No live shows on Monday. Market is not open, so we are not open for business. And then on Tuesday, I will be doing a workshop. When I figure out the title, I will certainly hand that over to everybody, but I don't have it just yet. For today's agenda, as we said, Rick is here. He's going to be talking about the In the No Trader. 10 in 10, our first symbol is going to be Masco Corp, MAS. And then we're going to finish off with a segment called Spotlight Stocks. So away we go, Tom. What's going on in technical news?
All right. Well, we did have some inflation data out this morning. So the January CPI came in flat. Market was expecting an uptick of 0.1%. And then the core CPI rose 0.2%, which actually matched expectations. So really nothing earth-shaking in terms of the inflation data. And when we take a look at what's going on in the bond market, really not a whole lot. I mean, we have risen now on the yield for 3 straight days. I've been mentioning quite a bit over the past few months. It's really been a struggle for the yield to get back up above this 20-day EMA, which is this green line on your chart. And so, we got back up above it intraday. We were up to 2.715, and you can see now we have backed off of it, back at just below 2.70. I'm really watching to see whether or not we can break back up above this reaction high from the early January low, which is at 280. The January low is down 255. I think we're range bound right now on the Treasury yield, and a breakout above 280 would be somewhat bullish for equities because, again, you got money rotating out of Treasuries, which sends the yield higher, and that money can then be put to use in the equity market. So the equity market obviously is fueled by new money, but it's also fueled by money rotating from other areas and other asset classes. So something to keep an eye on for sure. All right, let's take a look at some of the earnings reports. Still a lot of them coming out. We've got a ton. America Mobile, Occidental Petroleum, Activision, Blizzard, Twilio. Twilio was one that I really was trying to keep a close eye on, and Twilio only matched expectations. We'll take a look at that chart in just a minute, but that is one that certainly is having an issue. Hilton Worldwide, HLT, beat estimates. Tiva fell short. Global Payments beat. I mean, you can see the numbers were all over the place. After the bell tonight, big one is going to be Cisco. Cisco will be reporting. And Network Appliance, another one I think that's interesting as well, will be reporting. So let's take a look at some of the charts here. So first up is AMX. Let's take a look at the AMX chart. Here was a stock. They came out with earnings of 15 cents instead of 22. That was expected. So never good to miss your estimates. And you can see with very heavy volume today already 2.6 million shares. We're not to the halfway point of the day, so we're probably looking at 5 million shares or more. And you can see that 5 million shares would be pretty big volume accompanying this move back down. Can it hold its 50-day moving average? We've seen some recent movement to the downside off of that earlier February high. And so holding on to this 50-day moving average, I think, is pretty important. One of the things I like to look at are the negative divergences and what, the implications after you see some of these divergences. Higher prices, lower PPO. Now, the PPO is just measuring price action, so it's telling us that price momentum is slowing to the upside. There is a reversing candle where it leaves that long tail up 1650, comes back down. Looks a little bit like a gravestone doji for those of you that are candlestick fans. So you got a reversing candle, a negative divergence. That usually is not a good combination. And you can see with its earnings taking a hit back down to its 50-day moving average. But when I see a negative divergence, a lot of times if we can pull back to the 50-day, hold right around that area, get a reset on the PPO near the center line, we can then begin another trend back to the upside. So I do think we're at a critical area, a turning point, if you will. It's a segment that we like to feature on Market Watchers Live from time to time. I think that AMX is at one of those key turning points now. OXY, this is Occidental Petroleum. Now, they beat on their estimates there. They beat both revenue and earnings per share estimates, but they could not break out above prior resistance, which is that $68 level. We went right up, tested it, hit 68.05 this morning. We backed off of it. I think we're just trading here in a range between 64 and 68. On a relative basis, I think if we pull this up on a relative chart, you will see a couple of things. Number one, its peer group has been continually downtrending, but Occidental Petroleum has been one of the better stocks within this particular area of energy. And when we look at the relative strength versus the benchmark S&P 500, there's a problem here. You can see OXY has been declining mostly because of its peers. Its peers this has been one of the worst areas of the market relative to the S&P 500. So the problem here isn't so much with the stock. They did, like I said, they beat on their bottom line, $1.22 versus $1.10, traded up, tried to get through resistance. The bigger problem, the more macro problem, is that the energy group, and particularly its peers in the oil equipment space, has really struggled. And so until that changes, we're probably going to be looking at range-bound activity here on OXY. Twilio, this was a big one that I was watching because it's been one of the best performing stocks in the software space. Now, they beat on their revenues. They matched their earnings per share estimates at 4 cents, as I showed I talked about earlier. But this pullback here is, 7.7%, pretty significant. But that was the breakout area right here at 105. So currently the stock is trading down close to a key support level. I think if it could reverse off of that and start moving back up later today with heavy volume, I think that could be an indication that the stock is still looking pretty good technically. On a relative basis, this is what I was talking about, and these are the types of stocks that I'm most interested in. You get a stock like Twilio that has been rolling up higher relative to the software group. You get obviously the stock's been doing very well versus the S&P. And then, of course, software has been strengthening against the S&P 500. So you got a strong industry group within or a strong stock, within a strong industry group. And that is usually the formula for outperforming. And you can see the stock has been a great performer. $30 a year ago, even with today's $7 decline, still $106 and still in this uptrend. So I wouldn't give up on Twilio, but let's see whether or not short term it can hold on to its 20-day moving average and price support. Let's take a look at Global Payments, GPN. They barely beat their estimates, $1.33 versus $1.32. Big gap up here, but I'm thinking that stock may come back down and fill that gap. Well, let's see how we finish today on this particular candle. But software, as I said, nearly breaking out. Before today, Global Payments was still quite a bit below that breakout level. And so you can see on a relative basis, this has not been one of the best performers, but today it is making a relative breakout versus its peers. So we'll see. Versus the benchmark S&P, obviously it's been doing very well because it's beginning to strengthen against its peers, and its peers, as I mentioned, have been so strong versus the S&P 500. So a lot to like on the chart, but I prefer seeing maybe a gap fill back to that 117.50 level. We'll see maybe if we can get that. Final thing I wanted to point out is I pulled up the industry summary, and I went back and changed the period from intraday to 1 month, just so we can kind of look back over the last 30 days to see what's been working in the market during this rally. And so within communication services, and you're going to see it all over the place. Communication services, internet, up 10% in the last 30 days, but mobile telecom down more than 5%. We've got other areas, though, consumer discretionary, and I just did a break it down segment on consumer discretionary recently, and you can see a lot of strength in the consumer discretionary area over the last month. Really, automobiles, the only one that has struggled over the past 30 days. Consumer staples, again, some better, some worse. Same thing with energy. Coal, not so great, but renewable energy doing extremely well. A lot of the financials have done well, which maybe is a bit surprising given the 10-year Treasury yield decline that we've seen. But the last couple of days, financials certainly have been leading as we've seen a little bit of a bounce in that 10-year Treasury yield. Healthcare, a little bit of a mixed picture. Industrials have been strong. Check out aerospace, up 15% in the last 30 days. Of course, Boeing, TransDigm, a couple of really big names or good names that have provided some excellent quarterly earnings reports. Then you've got materials. A little bit of a mixed bag here, but until recently, the dollar had been declining. The last 8 or 9 days, though, we had seen a lot of strength in the dollar, and that was starting to wear on materials' relative strength. And then real estate, which was the only group to lose ground yesterday, actually has had a very nice run over the last 30 days. I'll show you that chart in just a second. Technology continuing to do well, and utility. So as I look up and down, I think what we're seeing is wide participation to the upside, which is good. Obviously, we have our leaders and our laggards, but the wide participation is something that does characterize a bull market move. We are seeing that. And real estate, you can see the huge move off of that December low. It does look like it's getting a little toppy to me, a little bit of a rounded top. PPO, a little extended to the upside, starting to roll over as well. So maybe we'll see some sideways consolidation here. But Erin, I know you've got upgrades, downgrades. I'll let you get into it, and then we'll bring Rick in.
All right, sounds good. More downgrades again this go round like we had yesterday. So we'll go through some upgrades, but I definitely have more downgrades for you. So first of all, Aptiv was upgraded today by Goldman Sachs from a neutral to a buy. As I took a peek at this chart, what was really interesting to me was this tiny breakout right now we're getting in the shorter term. Not just above these tops that we had earlier in the month, but also above that 200-day EMA. It'll be interesting if it can hold and trade completely above that 200-day EMA. And when I looked at the PMO, I thought, oh, this is an overbought PMO. But remember, the range is usually, you know, it's the same -4 to +4, -6 in this case to +6. So we actually have some room to see the PMO rise even further. And, you know, we have that bottom right now just above that signal line, nice gap up here. If it could stay above that 200-day EMA, I think you could get some of a little bit more of a run out there, probably to that 8250 level that you can see right here. Those bottoms from September came in at about, yes, 8250. All right, next upgrade for you is Medical Properties Trust. This is a specialty REIT. It was upgraded today by Jefferies from a hold to a buy. And here is a similar situation where the PMO looks like it might be overbought, but it really isn't, because the top of the range is around 4, meaning you have you know, there is still a little bit more room there, but mainly I would look back here and see how low our PMO has gone before. Here's how you can check that range. Let me just check the range to make sure I'm giving you all the right information. But yes, between +4 and -4. So while we are getting fairly overbought here, we've seen the PMO get higher on a nice rise. And as you can see, the OBV has been behind this move as well. All right, let's move on to some of the downgrades. Deere was downgraded today from a buy to a neutral by B of A Merrill. Not liking this chart, but I think there's a little bit of mixed signals going on here, and I kind of like it. You have the PMO, it has that sell signal, which of course is, you know, you don't want to see that. However, there is this bullish pattern sitting out here, a ascending triangle, which would imply that we'll get the breakout to the upside. But what I'm looking at here is, okay, the PMO, we're losing some momentum, so maybe it's a time to come back down and test this rising bottoms trend line that is part of that bullish triangle. So this is actually a good thing, I would say. We can pull back and then open up for not only a move to the top here to that resistance level, but hopefully a breakout to get you to that 170, 172.50 level. But I would hold off, watch this one. It did come in on a downgrade. And so, like I said, I think we're going to see some downside. But after that, if we get that bounce, that pattern is very encouraging. All right. Consolidated Edison was downgraded today by Evercore from inline to underperform. You know, a lot of these we're looking at them as moving to neutral, but this one was especially bad, I guess you want to say, as far as the decline. And, you know, utilities have been doing fairly well because of the market moving lower. It's the defensive sector. And this is kind of a mixed bag. You've got a PMO buy signal. You have the OBV bottoms moving up here in conjunction with the rally. And the scooter, while it has lost a little bit, it's still staying above that level that it's been in, you know, those lows back from January. So it is holding up there. But this pattern, a bearish pattern, I would just be aware of. You know, the 50 is crossed above that 200. It actually missed the negative crossover. And now we do have the intermediate term trend model with that 2050 positive crossover that is a buy signal. So although this one was downgraded, I don't think the chart looks that bad. All right, another downgrade. Huntsman Corp was downgraded by JP Morgan from an overweight to a neutral. As you can see, we've got the bottom above the signal line. You have a PMO that may appear to be overbought. It is for this past year, but we know that it can go higher because, again, the range will be equal to the downside. So at a minimum, we would be looking, even if this were an outlier, we'd still be looking at a low of around 5 for that reading. So I don't think this one is terrible. We've hit this area of overhead resistance and now we're failing again, but we do have the buy signal in the intermediate term and that bottom above the PMO. So I think we will find that breakout, but you know, it is on this downgrade. All right, TAP was downgraded today, apparently because consumers aren't drinking enough. And I kid you not, that was what I read in there. So I guess the market is getting better since people aren't drinking enough. We do have the PMO sell signal here on Coors Brewing. And it is in consumer staples, and this does give me pause because, again, this is another defensive sector and we're seeing some failures here. But we need to hold this level. That was, a level that we held back here in May, that was established back in May, fell below, came back. Worst case, if we get that breakdown, I would be looking at 54 as the downside for it. And that completes the upgrades and downgrades. Whew. A couple of others that I didn't cover, upgrades, Bloom Energy, Freeport, McMoran, Lattice Semi, Shopify, Ellie Mae, and DocuSign all upgraded. And extra downgrades, we had Aquantia, which was downgraded by 2 agencies on an earnings miss and significant cut to expectations. China Mobile, First Data, and Qualys downgraded by 2 agencies as well, with their guidance for the coming quarter being well below expectations. And there we go. All right, time to bring in our special guest. I went a little bit long, I apologize. Rick, are you ready to show us what you've got here as far as in the know trader goes?
Sure. Let's
I know.
go share my screen. And there we go.
I will be watching the chat room for questions. So
good, because I'm going to be asking some questions, and hopefully we get some responses that will help elicit further conversation.
Excellent.
So thanks for having me. Wanted to start off by explaining what In the Know Trader is and how it came about. So I've been on the street for, dare I say, over, I think I just started my 38th year on the street, and have had various positions on the street. I started with 12 years trading in the commodity pits, and that's really where I kind of learned the business. And the trading side of the business too, because when ultimately I became strategist at several top firms on the street, including Morgan Stanley, where I was chief market strategist for many years, the fact that I had a very good trading background really helped me understand markets in a way that many people don't, who are pure analysts and who haven't actually traded markets and understand the psychology of trading and how much it has effect or a factor in how markets move. So in giving a little background, I realized years ago, and I'm talking probably in the neighborhoods of 25 plus years ago, this elements of psychology, having been the trader, having realized just even my own emotional influences that affect how I traded, just how important this is. And I realized it couldn't just be for me, it had to be for anybody was making financial market decisions. And I started looking at a subject that really back then had virtually no material available, which was what today we call behavioral finance theory. And ultimately over time, I kind of became very well known for behavioral finance theory, not just on the academic side for being able to teach it. So I was the first to teach it at New York University, but also how to apply it directly into the markets. And that's something very few people have been able to do specifically. There are a lot of people who talk about behavioral finance in a general sense, but very few people actually can figure out how to make money with it, with the concepts of it in the marketplace. So there's a lot of people who essentially know the academic side, but very, very few people who've been able to figure out how to increase profits and use the concepts of behavioral finance in trading. So when I started thinking about all these years that I've been a consultant, since I left working for sell-side firms on the street, I've been a consultant for years to institutional clients who make up the bulk of the base that I have, and the businesses that I've always run were to the institutional side. So I talk to hedge funds and long onlys and pension funds all the time, and these are my main clients. But just shy of a year ago, it occurred to me that the individual investor really had very little access to the type models that institutions use to trade the markets. And they're not the typical, even if they're technical traders, most institutional traders are not using the type technical analysis tools that most individual investors use. Will I say that they never look at a 50 or 200-day moving average? No, I'll say they do, but they're not looking at it in the same way. They're often not trading off of them. They're not looking at the crossover the way an individual investor may, and take the idea of a golden cross or a death cross or any of the things that kind of the individual side has named and decided that these are meaningful things. Institutional traders work with a different mindset. And part of it is looking to see what the little guy is doing, and part of it is to see what other institutions are doing. And this is where the role of behavioral finance comes into the marketplace, especially on the institutional side. So when I put In the Know Trader together, I think it was last April that I launched the very first issue. And by the way, you can go to inthenowtrader.com and take a look at kind of what we do and the background that this comes from. The intent here was to provide individual investors access through my writings about the markets to how institutional portfolio managers and traders actually trade the markets, because they're not looking for an overbought signal to sell into. They're not necessarily looking for an oversold signal to buy into, the same way kind of individual investors take technical analysis almost, dare I say, as gospel, instead of the way I look at it, and many of my colleagues do, which is simply a tool to help better time the odds of that what you're doing in the market is slightly better than a flip of a coin, right? In theory, market can move up, it can move down, and of course it can move sideways, but it's essentially a flip of a coin at any given time. So technical analysis helps understand what trends are, if things are in trends, potentially buy into support in an uptrend, sell into resistance in a downtrend. But the institutional marketplace looks at things a little differently. Of course, that basic part they can do. But their focus is more so on trend exhaustion, because any portfolio manager knows the most money is made being correctly positioned for the next move that's coming. And then if they're correctly positioned and that move comes, they can let all the other investors in the marketplace push and create the trend that they foresaw coming. So if you think of, here, let me take an example. If a stock bottoms at 20 bucks and then ultimately rallies to, let's say, 60, and then starts pulling back, you had a $40 move. So if you bought 20 and sold 60, you made 100% of the move. You took out the best you could. The problem is most people and most tools out there that exist don't get you to buy a stock that goes to 20. They probably won't get you long until it's, I'd say, mid-20s. And if something peaked at 60, by the time you realize the peak is the peak, you're probably selling it at 55 or less. In fact, fair to say it's 55 or less. And therefore, most traders and classic portfolio managers on the street, those who are really fundamentally oriented and will only lightly look at charts, tend to miss 15 to 20% of the available move on either side of the greater move, which means at best, they've got 70% to work with. And if you know anything about statistics, 70% represents the first standard deviation of price activity. So they're kind of playing in the fat part of the bell curve. And what I've done and what the better institutional traders do is look to play in the second and third standard deviations of price activity. In other words, play the tails more. Buy when there's blood in the streets, because there's enough information and perspective that's likely darn close to the low, and that we don't need to see, the S&P rally hundreds of points or the Dow thousands of points before we say, oh, that was the bottom. I guess we're in a bull trend. And the same thing on the top. So In the Know Trader was born out of my desire to help the individual investor get access to the way institutional traders think. And again, myself having been over 3 decades on both the buy and sell side of Wall Street, I come with that type background as well as a real trader's background. And In the Know Trader, yeah.
A question for you,
Sure.
Maybe just for a little bit of clarity here. So when you're looking, at the market and you're looking at, potential bottoms, tops, and so forth, are you looking to get either fully invested in the market or move to cash, or are you looking more at just kind of moving your money around the market, going from maybe one area of the market that's run to another area of the market that's been lagging? So is it more looking at relative strength or looking for reversals in relative strength, or is it strictly, okay, the market's run too far, I'm going to move to cash. Okay, now it's come down, now I'm ready to get back in. How would
the answer, Tom, to that is yes to all of them.
Okay.
I will look anywhere and everywhere there is opportunity that presents itself, whether it's in relative terms, whether it's in absolute terms. And we'll take a look here. Let me pull up, for instance, let me see if I can get to, let's look at the S&P. So here's a chart of the S&P over the last few months. Here's the all-time high in early October. Here's the low in December around Christmas time, and here's the move since. I'm going to look at signals, again, and some of these models are not available to the general public unless you really want to lay out some serious coin. So for instance, one of the models that fits very nicely into the work I do, which tends to be counter-trend analysis, is a model by Tom DeMark, which is called Sequential. And Sequential is a model he developed in the early 1970s. It's been minimally tweaked since. So we're talking, almost pushing 50 years that he first developed this. And it's basically the same model from now that it is now that it was 50 years ago. Which shows the robustness of the model, that it didn't need to be continuously tweaked and backfitted. So I understand in the time we have here, I can't walk you through the whole model, but I will say that part of In the Know Trader, besides being a newsletter that I have myself for clients that anybody can join up in, is also every week on stock charts. On Tuesdays at 3:00, we do a show just like you guys do, but it's called In the Know Trader. So it's a webcast on stockcharts.com that in the last 3 weeks, I have more in-depth explained what this model is so that people can become familiar with it and understand what I'm doing in the Know Trader newsletter. So we do this half-hour weekly webcast on Tuesdays. As is many of the shows, it gets repeated multiple times. It then goes over to YouTube. So these are fully accessible. If you search for my name, Rick Bensignor, on YouTube, you'll see all these stock charts in the Know Trader webcast that we've done. And it's a good way to get a sense of some of these models, how I use them, why I use them, and the type signals they can get. So for instance, without going into all the details, I can tell you that when we get to a 13 count, it often represents a very poor time to be playing the trend in the direction that it had been moving. And often, if you're somewhat aggressive, creates a sense of possibly fading the trend. So just a couple days before the all-time highs, we have a 13 suggesting exhaustion of trend. We've just now rallied significantly. We're through a 62% Fibonacci retracement, which lots of individual investors look at, some, but less so on the institutional side. But we're getting close here on a shorter term basis to a potential peak in price. And I myself did some selling of names that I had bought in December yesterday, knowing that we're awfully close, not having the need to try to time it exactly right, but very willing to take some healthy profits on names that I've been long since mid-December. Excuse me. So this is just one of the models we look at, and again, you can learn more about it. You can look at some stuff online, but if you tune into the last 3 webcasts that we've done for stock charts over the last 3 weeks, I walk you through this model and show you some of the implications of signals that show up. Now, part of In the Know Trader 2 is trying to get you to think more like an institutional trader. And it doesn't happen overnight. It takes time. And part of it is kind of potentially opening your eyes to new and different ways of looking at the markets than a pure 100% technical way, which many people do, especially who are stock charts viewers. They're technicians, and yes, I'm a technician, but I'm also a market timer and I'm kind of a behavioral market specialist. So I'm looking for all different signs of what could possibly be the end of a trend that people will not understand or realize is the end of the trend. The move down in December, even here, if we take a look at the S&P, we know that it took out here. I'll make it, I'll put an ellipse around or something. So here's the February low that had held for the whole year until we broke down in December. And the breaking down, the severity of the breakdown made everybody say, okay, I don't want to say everybody, made many people think we're in a bear market. I've been telling clients for over a month, we are not in a bear market. We were never in a bear market on this move. And this overshot to the downside actually just minimally broke our downside target of 2371 by about 1%. And the day after it does that, the Dow or the S&P rallied, I think it was 115 points. The Dow rallied 1,000 points. And, we were in print to saying this is a low, a solid low, but I can't tell you it's the low. Until mid-January, I came across a different chart, and I think I have it here. Let me see. No, it's in.
I got a question while you're looking this up, Rick.
Yep.
I can see all those numbers in there, almost like counts. Is this similar to Elliott Wave?
No, it's
not at all.
It's actually not at all.
Okay.
So the counts you're seeing here are actually relationships, and it's simple math. The counts are simple math. It's relationship between price bars. A 9 count up, and this is a monthly chart of the ACWI All World Index ex-US. This, I'm just using this as an example, but you'll see anytime you go 9 consecutive price bars, in this case it's months, so 9 consecutive months that the close at the last trading day of the month is above the close from 4 months prior, the bar gets a number to it. And it's looking for this to happen 9 consecutive times. If any time along the way, any one of these closes is not above the close from 4 bars back, the numbers drop off, and you actually get a 1 showing up underneath the price bar, suggesting that this close is less than the close from 4 bars back. In order to do this phase of this DeMark model, you've got to minimally go 9 consecutive price bars, close above close from 4 months ago. In the case of a monthly chart, that's often all a market moves before it gets some type of pullback. You don't necessarily know how much it is, but it helps identify, again, potentially a lousy time to be a buyer in an uptrend. The same thing here on the downside that marked the low. Hold on, let me pull this down so we can get the dates in here. Do a little more. So here in 2016, when the market sold off, this happened to conclude 9 consecutive months that the closing price in this ETF, ACWX, was less than the close from 4 months prior. And we move up, we go sideways, but it's only until this part here in 2017 that you actually go 9 months close above the close from 4 back. And we did extend a little beyond that. But what made me turn very bullish in January and help conclude that there was no bear market and there is no bear market coming is that this ETF, which represents the All Country World Index minus the US, right? So this is basically all of Europe and all of Asia, the best markets there. Whereas the US didn't break really until the end of the year. The rest of the world was kind of selling off the whole year of 2018. And we actually got down to 9 consecutive months starting January that the close was less than the close from 4 months prior. That happening against the uptrend line that came from the 2009 low against another element of this DeMark model, which is this horizontal line, said to me right in here that there is very high chance that there is no bear market and whatever decline Europe and Asia had seen is done. So while many technicians are looking to sell into the rally and saying, we've broken down, we took out the February low in the US and keep looking for places to be sellers, all I'm saying to people is we need to find places to be buyers. And when I cut down to shorter term, and that's, for instance, the S&P chart I showed initially, I can see that at least on a daily chart, we're getting closer to upside exhaustion here, which doesn't mean you sell everything in the house, but that you do want to perhaps take some profits. We've had a huge run in the market since the December bottom, and that we may very well be close to a peak, which you would not see in many other indicators. In fact, I'll tell you that this particular model is, as far as I'm concerned, the single most accurate model there is to calling a trend exhaustion as close to the actual turning point as there is in all of technical analysis. Now, does this model always get it right? Absolutely not. Not a chance. But is there anything that even comes as close to this model and be able to call turns? To my knowledge, no. And I know hundreds of technical indicators. Anything that's based on a moving average is never going to call the turn exactly when the turn comes.
Hey, Rick, do you ever use any, and I'm sorry to interrupt you, but do you ever use any sentiment indicators?
Yes, I do.
Like volatile.
So one of my favorite sentiment indicator, and again, this is a subscription-based, is something called the Daily Sentiment Index. And I include this in my institutional newsletter. So this is a poll from a company called Network Press. Network Press is owned by the very prolific author Jake Bernstein, who has written more books about the markets than any person, I believe, who's ever lived. So Jake's been writing books for 40 years, if not longer, on the markets, has probably 30 to 40 books in print. And his company takes a poll every day after the markets close of about, 24 to maybe 30 different futures markets, simply questioning, are you bullish or not? And so the poll results are reflected as percent bulls. And unlike the AAII poll or consensus or any of the other ones, this has to get far more extreme in numbers to potentially be useful. So instead of AAII that says maybe 60% are bulls and 30% are bears and 10% are neutral, and you're saying, gee, 60% is kind of heavy and too many bulls, this generally has to get 85% or above to show extreme reading. And just because one single day gets above, it's not enough for me to fade. But for instance, when oil was up at $76 back in the fall, it was 96% bulls. And that's part of the reason that we were very negative oil in the 70s and telling people not to be a buyer. When the S&P got down to the February low this year, meaning last year, 2018. So we started, we did the sell-off in January. In February, I think the bullish number for the DSI poll came out at as low as 6% bulls, right? Nobody was bullish. So yes, I do use sentiment indicators to help time exhaustion levels, but they're not the classic ones. And just so you know, this particular poll, the pollees, the people who are polled, are non-professional futures traders, right? So they're the moms and pops, they're the individual investors who trade futures, which tend to be pure momentum players. They may not trade orange juice, but they're responding to what they think orange juice is each day. So they're going to look at a chart, and the chart's pointing up, they're going to be bullish, and the chart's pointing down, they're going to be bearish. There gets to be a point that you get too many people on one side. And again, I've used this poll now for got to be close to 35 years. And it's a very helpful tool. But again, it's not a free poll. It costs money. But I find it particularly useful. So the answer is yes, I incorporate sentiment. I also talk to professional money managers throughout the day, and I'll get their collective thoughts on what they think is going on in the market. And when I hear too many on one side, I'll also look to see what other indicators are saying. Do I have too much bullish consensus in that? Do I have sequential, this model that we're looking at now is just one of many, many market indicators that exist that I use, that combined along with cloud charts and other indicators help me put the picture together. I do want to show, well, we still have a few minutes left, what, let's see, where are we?
Yeah, we've got some viewer questions too.
Okay, so let's take some viewer questions. And by the way, here's just like last week's issue of In the Know Trader. So this comes out Wednesday nights. I'll be writing one this afternoon. We look at the U.S. equity market. So again, this is for individual investors. What you see here on the U.S. equity markets is very similar to what I write my institutional clients. We're talking about the VIX range here. So each week we typically look at the VIX and what it suggests. We'll look at market breadth. But here, if you look at a chart of market breadth, you'd say it's ripping to the upside, and there's no reason to think anything else. But notice where turns were called using the sequential model. Back in March, it nailed the low at a time you wouldn't particularly expect the low. It calls the low in October for a rally that lasted a few weeks, and it pretty much calls the bottom in December. So whereas if just you're looking at the breadth figures and saying this stuff's falling out of bed, it's really bearish, I'm looking at this and going, hey, this lines up with the call I'm seeing in the ACWI index that markets are likely bottomed. This is a much better reason for me to fade the move that most people are looking at, and in the way I look at it, exploit the mistakes that they make. Mm-hmm. And now we're getting much closer to a top. Last week we hit a 13. It's probably a little higher than here, but it's starting to suggest to me, we're kind of late in this piece of the rally that will get some pullback. Are we going back to the lows in December? In my eyes, not a chance. So I'm always going to be looking to be buying dips now. And it doesn't mean we need to take out last year's high in the S&P. We had a 600-point range. Does not mean in 2019 we have to take out the high. But I am looking to be a buyer on any significant pullback. Okay. You mentioned a couple of questions. Let's try to get to them.
Yeah, I was going to go ahead and go through these. I know there was one. I think you mentioned earlier, we were talking about standard deviations, and a question came in, why standard deviation rather than ATR, which I'm guessing is average true range.
Average true range is simply a number, a historical number of what the range is over time. And it's done, let's say, on a daily basis. You look at ATR, or if it's a weekly chart, you're looking at it on a weekly basis. What I'm trying to say is that here, look at, for instance, this S&P chart we're looking at right here. We bottom at 2345 or so in December. Now we're up near 2750. So the best you could have done was bought the exact low and sold, let's say, today, right? You would have taken out 100% of the move. What I'm saying is most technical indicators are not designed to be able to do that. The best you can do is take out the middle 70%. And 70% is not bad. But if you could have foreseen that this move in here, as bad as it looked, was actually the buying opportunity, then you can take out much more than 70%, and therefore you have a chance to outperform. So if you think of this in terms of how a portfolio manager is benchmarked to the S&P or let's say the standard benchmark, just getting an average return doesn't really help them increase assets. They've got to outperform. And the only way you can outperform is playing the tails of moves correctly, not playing the fat part of the move in the middle. It's really very hard to outperform when you've missed the turns correctly. You'll get the average return, but you can't outperform.
Fair enough. Another question, since the DeMark sequential is not available to small investors, is the Elliott wave as close as I can get? I'm assuming with your answer earlier, it's really not Elliott wave.
It's truly not Elliott wave. DeMark actually has his own version of Elliott wave, which is purely mathematical. So it takes all subjectivity away for what waves are. But no, this is not Elliott wave.
Okay. Now, you've shown a lot of longer term charts, but one question that came in I thought was interesting is, have you tested these signals? Do they work for day trading, or is it more swing trading?
Okay, so let's just pull up, let me pull up an S&P chart. And let's turn this into a 5-minute chart. And let me take off Ichimoku or some other things just to... So this is real time today. The high of the day is on a 13th. Just didn't know it. Just turn to this chart in response. Here's a couple days ago. Here's a 13 high here. Here's a 13 low here. Here's a 13 low in here. Here's a 13 low here. So you're getting the sense that you really want to be a buyer more than a seller. Here you start getting a sense of a seller. There's the 13 tucked in here. Goes sideways for what is this, 5-minute chart? So a couple hours, then breaks to the upside. So yeah, and I can just pick 20 minutes. You've got the tops in here for a couple days sell-off, and here's a 13 that's not so good, and here's a 13 on today's high. So interestingly, we looked at a 5-minute chart and it nailed a 13. Counting with two completely different mathematics, you got a 13 on today's high here too, and a 20-minute chart. So you can pick, any market. And yes, this is an incredibly robust model. But you got to realize too that for intraday trading, if you're talking about a day that's a trend day, where you tend to, let's say, open near the low and kind of push higher all day long with minimal pullbacks, if you're trading a 5-minute sequential chart, you're going to have probably a fair amount of 13 sell signals that are not going to work because the market's moving up all day. So none of these things you can trade blindly. And if anybody out there tells you there is a holy grail, run as fast as you can, there isn't. There is no model that is always going to get it right. You've got to understand the context of what's going on in the market. And if you're going to fade moves, you better fade a move when it's really close to the exhaustion of the real move, not trading this on a 2-minute chart. If it's a sideways day and the S&P trades, in a 15-handle range back and forth multiple times, you'll get some good trades off. But if it's a trend day, you're going to get hurt. So you've always got to know what mode the market's trading to know which models to use. You don't want to use a trend exhaustion model on a day that's moving or a week that's moving, in one direction.
All right, you're sounding definitely bullish to me, so I think I've probably picked up on that correctly.
Correct.
Okay.
Now, not saying I'm bullish at 2750, right, but I am as convinced as I can be that the December low was not just the low in the U.S., but the global low, and that's really significant because that means the bear market that existed through most of the rest of the world besides the U.S. last year bottomed in December.
Okay. Do you ever short? I mean, if you get those 13 readings, will you short?
Absolutely. Absolutely. And I'll put on pair trades. Last week, the trade. So each week we put out a new ETF trade. It can be in either direction, or sometimes I pair a trade where you have a long and a short against it. Last week we bought gold and sold silver against it. And that's working. And that's even with the run gold had. I still think gold will outperform silver. So you buy GLD and you sold SLV against it.
Okay. A couple more questions and then we'll wrap up. But one question that came in, you got the Ichimoku clouds there. Is that an important element in your charting?
It's very important. It's so Ichimoku is a little known indicator in the Western world. That doesn't mean nobody knows it, but compared to the Eastern part of the world, they'll pull up a chart with Ichimoku on it the way we would start with a blank bar chart. It is the most basic way somebody in the Eastern part of the world will look at a chart. Back in 1997, I came across this model when I was at Bloomberg. It was actually inside the Bloomberg charting system, and it's one of the models I had never seen before. And I did as much homework as I could, and nothing was in English. But having written design models myself, I kind of could figure out most of it. But I actually got a little help from a friend in London who was on the foreign exchange side. And because Easterners are very big foreign exchange traders, he was familiar with it, helped me kind of put a few pieces together I hadn't figured out. And ultimately, I became known as the Western world's foremost expert in this model. I've had 3 book publishers come to me to write the definitive guide, and I actually choose not to because I know what most people don't, and that's a real competitive advantage for me and for my clients. So it is a core model, and I know it very, very well. I've spoken at conferences about it. And in fact, the Traders Expo show that's coming up in New York in March, I think it's March, whatever the Monday is, I think it's Monday, March 11th. I will actually be doing a very rare public appearance presenting how to use the cloud model. So if you're in the New York area or can get there, I will tell you, come and see it. I will explain to you things that are not known about this model. I do not give away all the secrets, but I will give you enough to use that this will become a useful part of how you look at markets.
All right, one final question, and I know we're not going to have time because this is going to probably be a little lengthy, but what I'm going to suggest maybe is that it could be a topic on one of your Tuesday shows, or maybe when you come back and join us, you can talk about this one. But the question was, how did the model do in 2000, 2008, 1987, 2016? I think the question is getting at, obviously when we've had some very, very difficult markets, how does the model do?
Are we talking clouds or sequential?
I think, well, it doesn't say. I'm assuming sequential.
And so let's say the late 1990s, when the market was ripping to the upside, if you use a daily chart, there are plenty of 13 signals that show up, and you basically might be right for 2 days and wrong the rest of the time and get your rear end handed to you. So when you have a strongly trending market, you may very well want much more to be looking at weekly charts than daily charts so that you get less signals and you increase the chance of the accuracy of it. Sometimes trends are so strong that you've got to look at monthly signals. So part of this, again, is understanding what's going on in the market. And if you're going to try to fade a move, you better have pretty good confidence that what you're doing is like either catching a falling knife or trying to stop a runaway train. You've got to really understand risk management and what are the risks involved in trying to do that. And the first question I'd say is, why are you trying to do it? Is it to fulfill your ego and say, oh yeah, I sold it 2 days from the all-time high and stuff like that? You really kind of have to know how and why you're doing it. I can tell you, and if you want, we can finish with this. Only twice last year, Tom, did we tell long onlys, in other words, mutual fund companies that are long, to hedge books. Now, for them, that means rotating to more defensive sectors. For hedge funds, that actually means hedging books. What was 3 days from the all-time high in January, we told people to hedge their books. And then 4 days after what is still the all-time high. Those were the only 2 times we hedged our books last year. And that's from a combination of signals that had me say we are likely exhausted. And from a portfolio risk management point of view, you're much better off putting on hedges and moving defensive than staying with what you have on. So do I always get it right? Nope. I was right about not being long oil in the 70s, but I stepped in too soon at 60 and didn't sell out till 56. That was the worst trade we had all year, was buying oil at 60 and selling it at 56.
Yeah, that's not bad considering what the market did.
Yeah, it went to 42.
Right. All right, well, it has been a pleasure. Now, I'm assuming that there are ways that folks can contact you and subscribe for your service?
Absolutely. So the best way to reach me, and let me see, here we go. Let's go back. How to contact me, rick@inthenotrader.com. And again, check out inthenotrader.com, the website, and that's my email. And so if you're interested in subscribing or seeing kind of what we do, check out the website and reach out to me, and I'm happy to help you.
Sounds good. Always a pleasure to have you on the show, Rick. I do want to point everyone towards your show that airs on, it's Tuesdays, 3 o'clock Eastern, right?
Correct.
Okay. Definitely check it out. I mean, I think the numbers and all that you were showing on here are fascinating. That did predict a lot of the turns. Again, I just want to thank you for coming on and sharing everything with our group here.
It's my pleasure. Thank you, Tom. Thank you, Erin. I really appreciate being on.
Excellent.
Awesome. Yeah, it is fascinating. I mean, everybody, that's the key in the market, is to try and figure out where's the bottom, where's the top. I mean, if we could figure out those two things, I think the rest would kind of fall into place. It's not easy. It is not easy, that's for sure.
I think we all in the audience can agree with that statement.
No, it is. And I'll tell you, it is far more difficult doing what I attempt to do than playing that middle part of the curve. But if you can figure out how to do it, it is far more profitable. If anybody knows statistics, you know that when you play in the fat part of a bell curve, you might just as much buy high as you do buy low. So that stuff tends to average itself out, and you kind of spin your wheels. The real way to make money is selling that second and third standard deviation and buying the first and second the second and third on the downside, and leaving the fat part of the bell curve for everybody else to push the market in the direction that you're already positioned for.
Well, I'm a professional wheel spinner.
You watch hamsters and you learn from them, right?
Yeah. Anyhow, great having you on, Rick. Really appreciate it. Thank you.
Thanks, guys.
All right. Let's go ahead. We're going to go ahead.
Yes, 10 and 10. Let's just get right to it.
Yeah, I'm going to jump right in. I know we're running just a bit behind, but that's all right. That was a very interesting discussion. I didn't want to miss it.
Absolutely.
Okay, so here is the first one. I believe it was Masco, MAS, and I'll try to go through these pretty quickly. I'd already annotated this. I do like the fact that the group has broken out. Its peer group has broken out on an absolute basis. Masco, relative to its group, has broken out. You can see it bottomed a few months ago, put in a high, pulled back, and it's now broken that high. So it's starting to stair step higher, which I like. It's doing well versus the S&P 500, doing the same thing. And its peer group just broke out, had a double top, and broke out relative to the S&P. So there's a lot of things to like here. But as Rick was just talking about, you want to be careful you don't chase. And so the stock has been up quite a bit. I like it. I think it goes higher. Where would I think the best entry would be? Well, had the gap up, had a lot of volume coming in from that 34, 35 area. So if we were to see a move back down into that zone, I would think the reward to risk would be better.
All right, excellent. Most popular in the chat room is XES, and they wanted to also add seasonality in there if you can.
Yeah, we're running short on time. I'll try to do it real quick. I would just say right now we've got that gap resistance area. You can see the heavy volume that kicked in December from about the 11.5 area. And now on this move back to the upside, we're really going flat. I wouldn't have to pull up a relative chart to tell you that the XES has lost its relative strength here over the past few weeks, because the S&P has continued its ascent, and you can see the XES is struggling. So I think we got a little bit of a problem here in terms of relative strength. So that's an area that I would be really careful until we can get that breakout above the recent highs. As far as the seasonality goes, and I believe energy likes this time of year. Haven't looked specifically at the XES, but we will pull it up real quick. And yeah, I mean, February, March, April, sweet spot, especially April. Now, would I buy strictly based on seasonality? No. If I like the technical picture and then I look at the seasonality and the seasonality supports it, to me, that's confirmation. So I don't use this as my my decision-making tool. I use it as more of a confirming tool. So yes, this is a great time of the year for the XES. If we get that technical breakout, I think this adds to the bullishness.
Excellent. Next one up, also popular, Zuora software company, ZUO.
Oops. ZUO. Well, if it's software, I can just tell you right now, I don't like it, because on a relative basis, it's going to be a tremendous laggard. Actually, let me just show you that real quick, and I'll point out the, yeah, you can see software. You can see the stock has been going down. So on a relative basis, it's one of the worst performers. So there's so many great software companies out there that have done such a great job. When you look at the money that's rotating into software, ZUO is not getting very much of its fair share here, that's for sure. You can see the relative strength versus its peers is way down. I'd have to see that really begin to turn back to the upside before I'd be interested here.
Okay, let's see. Next one up is going to be NSC, Norfolk Southern.
Yeah, Norfolk Southern, it's in the railroad space. I think it looks pretty good. It's kind of a go along for the ride kind of a performer relative to the railroad group. But check it out relative to the S&P. This was a multiple top breakout relative to the S&P. And look at what railroads are doing relative to the S&P. So I think you've got a great group. I think you've got a great stock. The only thing that makes me pause a little bit is NSC is up against overhead price resistance at that 185 level. I think we're going to go test it. From there, I'd wait for a pullback. I think re-entry somewhere, maybe back at the 20-day moving average, which held in back in January, or somewhere in this gap support area. I'm going to say 175. That would start to get my attention on a pullback. I think it's a great area of the market. I think this is a nice looking stock. I would just simply wait for a better entry.
Okay, I believe it was our only energy stock requested, BP Amoco, BP.
All right, BP, you can see the group really continues to put in lower highs. Not good, but the stock has actually taken out some of those highs. So the good news is you have one of the best stocks within the group. Unfortunately, you have a group that has been really lagging the S&P 500. So it's kind of a little bit of an offset here. I like the fact that it's holding its rising 20-day moving average. So I think as far as whether or not I would own this stock, I think as long as it continues to trade above that 20-day moving average right here, then I'm okay with it. You've also got some really nice gap support that comes in at the same level as that rising 20-day. So I'm going to say 41.25 or so. If you see it trading much below that, I'd be careful. Otherwise, it at least is one of the better stocks within the space.
All right, number 6, Tivity Health, TVTY.
Okay, very difficult to look at a stock like this, other than if you're a value investor and you see something, because the stock's traded down so much. When I see this, there's reason for it. Companies just don't, institutions just don't start dumping stocks just for the heck of it, especially in this fashion. Something is obviously going on here. I don't know the fundamental background with the stock, but I clearly see the technical background, and I'm not interested. TVTY relative to the healthcare providers has been one of the worst. So if you like healthcare providers, which I'm still okay on healthcare providers, I just think there are a lot of other choices that are so much better here. So what gets my attention on this chart more than anything is you have one of the worst stocks within a decent industry group. I would rather have the best stock within a decent industry group.
All right, next one up, CCJ, Cameco Materials.
Yeah, I think it's on a relative basis, you got a really good strong stock here. You can see relative to its peers, it's been going up. relative to the S&P, it's been going up, and that's no small feat considering that the group relative to the S&P has been so bad. So I'm okay with this one. I just think, again, you know, if you're not in the if you're not in groups that are going higher, it just makes it a much more difficult thing to do. So here is your uptrend on the stock. Here is your uptrend relative to its peers, relative to the S&P 500. But the problem here, without a doubt, is the lack of strength in its peer group. So again, another mixed bag. I like the stock, not so keen on its peer group.
All right. How about Target, TGT?
Yeah, Target trying to get back through this gap resistance level, and it did break back down below the 20-day. I'm seeing some mixed signals here. The broadline retailers have been going lower. You can see that Target just recently put in 2 lows. You don't want to see that support, that relative support, get lost. But I don't even like seeing it down there. Again, I like seeing all these charts going up from left to right. And up until the latter part of October, we were still looking pretty good. But when we started selling off right here in the first half of November, you can see that the relative hit was taking place relative to its peers. And then that gap down was just not good in a group that was, at the time, still doing okay. So I think you got to get back up above those highs. You got to see the relative strength turn. So I think for me, I've got to see the stock get back up above about 73, 73 and a half. Until that happens, I'd look elsewhere in the group.
All right. Let's see. Next one up, Baidu.
All right, Baidu. I think they've got earnings coming up maybe in the next week or so. I want to say February 21st or 22nd, something like that. Been downtrending. The overall internet group has started to rebound. The stock has not. So again, relative strength is horrible. If everyone else, you know, if you're looking at the money rotating away from the stock, you got to ask yourself why. Why is everyone, why are companies like Goldman Sachs sending analysts out to Baidu, finding out what's going on, and then seeing the stock sell off? That is not a good thing. So once again, for me, the stock relative to its peers is so weak. That would be the main thing that would keep me out of this stock. Now, the first thing I would look for to begin to see some strength would be a breakout above right about that 176, 177 level, get some volume coming in, and let's start to see some relative outperformance. Until I get that, I have no interest in Baidu.
All right, last one, Beazer Homes, BZH.
Yeah, Beazer, well, first of all, home builders had a huge day yesterday, rallied over 5%. Beazer went up long for the ride, broke out above its recent high. When you take a look at the home builders, I am starting to see some nice movement to the upside, and I'm also seeing some decent relative strength versus the S&P 500, where we bottomed back in October and we've been rising since. So we haven't made another relative breakout. That's something to keep an eye on. If we do, I think that really opens the door to some possibilities in this space. But Beazer relative to the S&P is strengthening, relative to its peers it's strengthening, and so I would be simply watching this area of support down around 11 and a quarter. Let me draw just a couple of lines in here real quick. But let's go with 11 and a quarter right about here. And then the prior highs came in at about 11.50. And you can see down here when we pull back, we hold on a closing basis. Notice also the 50-day moving average coming up from underneath. I think as long as Beazer stays above about 11 and a quarter, 11.20, this is a stock that I could stick with in the home building space.
All right, that does it. 10 and 10. That was a really good job. Here are the symbols that we just went over. I will get these charts as annotated up in the Market Watchers Live chart list at the end of the show. Just go to the Market Watchers Live blog. The link will be at the top, and it is also in every Market Watchers recap. All right, time for our final market update, and then we will get into some spotlight stocks. All right, here we go. As you can see, markets are all up right now on the day, but interestingly, the Dow, S&P, also the NASDAQ all pulled back from their highs earlier today in the morning. Mid-caps, 400 doing about the same, but it looks like it's coming back up. Russell 2000 has been really flirting back and forth with yesterday's close. So it's been negative, positive, negative, and back and forth and so forth. The Canadian markets also really mostly unchanged at this point. Treasury yields are higher, reading 2.702%. VIX is rising, but still quite low at 1561. UUP, big gap up, still making intraday highs, currently at 2583. GLD, traveling opposite, hit an intraday high and is now moving down, but staying in positive at 123.90. USO, big gap up, but consolidating sideways at $11.37. And TLT, big gap down, but trying to come back to life here, forming a bull flag. And that's all I have for the final market update. I'm going to pass it back to you, Tom.
All right, sounds good. I'm going to go ahead and start here with a chart that I showed yesterday. It was in my blog article from yesterday, and it's the hotel chart. And the reason I want to do this, there were a couple of hotels that came out with earnings last night or this morning. And one was very solid, the other was not. But both stocks, last time I looked, were actually hanging in. One was doing very well, Hilton, and the other one, Wyndham, I think, was still hanging in there. But one of the things I posted on here was in this chart, we were struggling to get back up through the 20-week moving average. But you can see on the downtrend channel, which has been very steep. So this is a group that relative to the XLY had been underperforming quite a bit. And this is something to monitor, because when we get a breakout, you can see this is a group that tends to also perform really well. And I believe in the historical tendencies, I pointed out how this is a group that tends to do really well in March and April. So I want to watch to see if we get this breakout out of this down channel, and also can we climb back up through the 20-week moving average. So if you click on the chart within a blog, you can get the live version. And I want you to take a look. We're up 4% on the DJUSLG now this week. So we are making this big breakout above that 20-week moving average, which I think is important. Now, here is a relative chart to the S&P 500, where it looks like the group is now moving to about a 2.5-month high. It also looks like it could be breaking this downtrend line. And then I wanted to bring this up relative to the XLY. And just wanted to give you an update on something we talked about yesterday. But here is that, and this is a daily. I wanted to go back. Let's go 5 years. Let's do a weekly chart. But if we look at this weekly chart, you can see we're trying to come back up through the 20-week moving average, and this down channel is at least threatening to be broken. So I think that the action right now in the hotel stocks is very encouraging, and is an area that maybe we might want to consider going forward. So we're going to move into the spotlight stocks. I figure we probably have about 4 or 5 minutes each, Erin. So if you want to go ahead and start it off.
Absolutely. So what I ended up doing was going just to our member homepage and looking at the most active on the New York Stock Exchange. And that's how I came up with the 5 I'm going to show you right now. So they're interesting right now to the market as they're trading, in high volume, but also technically they were interesting to me. So that's how I pulled them up. Bank of America was the first one. This one, while it might appear to be doing some great things here by breaking out from let me make this a little bigger for us. Well, it looks like it was breaking out from this declining tops. Well, it did break out, and you could make a case for an descending triangle, and that's a bearish formation. So to get a bullish outcome off of a bearish formation, I usually will take that as especially bullish. But look we've got a PMO sell signal, and actually if you take this in and we look at some support and resistance, you can see short term, even in the thumbnail, we're barely, that $29 range seems to be a problem. And look at where that lines up back here, where we had 3 tops back in October through December. So technically, while it looks, the chart pattern could be giving you a signal that, things are better than they look, I would say overhead resistance is really going to be the problem. And you can see the 50 is trying to get above the 200-day EMA, but it hasn't yet, and that means we're still in a bear market configuration. So between this lack of, the OBV not really confirming the breakout just yet that we've seen, and the price has been rising for like the last 3, and now this would be the 4th day, but we're only getting a little bit of action by the PMO to move to the upside. And again, the volume's just not there to the degree I would want to see it. All right, the next one I'm going to show you is Encana Corp. And this one also, we're seeing this nice upside move today of over 4.5%, but we have a PMO that is on a sell signal. We have, OBV has been in decline here. We've got obviously a scooter in the basement. I think really the best you could expect out of this, if you are going to be on the bullish side of things, would be a move up to that $7 level to test overhead resistance. Maybe we're developing a little bit of a trend channel or trading channel, because you can see it kind of matches up with these lows we had back here in December. But overall, not liking it. Based on just my PMO, I would not look for that move to the upside all the way up to that $7. You may be able to get up there and test that 20-day EMA, but I wouldn't. I'm not very optimistic about Encana. All right, General Electric, always a favorite and of interest. It's really not been doing much as far as the PMO. Looks like the PMO could be considered overbought, but if we take this out to about 7 years, we can look at what the actual range is. And of course, it's been stretched a little bit because General Electric has been having problems. So here we go. Typically, the range used to be between about 5 and -5. And really, you could make a case that the normal range was even between 2.5 and -2.5. But now we've stretched that range out with the huge decline that we saw starting in 2017. And I would say now we do have an overbought PMO. And we're still looking at a stock that is really still struggling. I know we're coming up, we've had this rally, but it's just been, as my dad might call it, tortured. It's just, we had to go through that long period of consolidation. We got that nice move to the upside, but basically are moving sideways again. Certainly not making a lot of money when it comes up and then goes down about the same amount. So I don't like GE. It is holding above that 950 level, but I think it's still pretty much a dog. I would still be staying away from it. And finally, I'm going to just go to Vail. We'll skip the other one. Vail, I think, looks good. Now, this is in steel. The only issue I have here is that 1250 overhead resistance. But look at the PMO. It's starting to look really nice, bottoming in certainly very oversold territory. The only thing that would give me pause, of course, is, we just had the long-term trend model sell signal. We haven't gotten ourselves back above that 20-day EMA yet. So there's still some work to do here with Vail. But I thought this one was looking interesting as well. So passing it to you, Tom, and left you a little bit of time.
All right, let's go ahead and roll here. I'm going to go through first. Now, these stocks I consider in the spotlight because it is earnings season. And the first ones I show you here are all companies that raised guidance in some fashion. So most of them, I think maybe all of them that I go over here at the beginning, will all show moves to the upside because of some really strong guidance that they provided. Here is iRhythm Technologies, IRTC. We went all the way up. We closed 84 and change yesterday. We went all the way up to about 97 earlier today, just about threatening the high from September before backing off. I think eventually, after maybe we pull back a little bit, I would expect another run and eventually maybe even a breakout above that 97 level. I think we're getting some really good action there. AVLR, this is Avalara. Another one raised guidance, big gap up. Look at the volume coming in. Needs a little bit of a pullback, but it is in that software space, and it is now starting to show a lot of relative strength versus software stocks. JCOM, this is J2 Global Communications. Look at that after the raised guidance. The stock now up almost 10, well, close to 11% here, and challenging overhead resistance near that 84 level. Huge volume today on the raised guidance. Hilton, HLT, they beat top line, they beat bottom line, they raised next quarter's earnings per share, they raised fiscal year 19 earnings per share. It's part of the hotel group that I was just talking about, and you can see a really nice reaction, stock up over 6%. And then the last one I had on the raised guidance side was CRTO. Look at the huge gap up here. Notice the gap up went right to this gap, traded above it, and then came back down. That's usually not a good sign. I look for it maybe to go back to this 26.75 area. We almost got there earlier. And then at that point, see if we can get a reversal back to the upside. Couple to the downside that I wanted to go over. ATVI, this is Activision Blizzard. Talked about this one along with Take-Two and the fact that this group's been underperforming. Well, Activision lowered guidance going forward. They missed on their revenues, missed on their earnings per share, lowered guidance, and still went up. I think it's just a little bit of a dead cat bounce. Hit the 20-day. We'll see if we can close above that 20-day. If not, be careful. The other one I wanted to point out here, WH. Now, this is, again, in the hotel space, Wyndham Hotels and Resorts. This company lowered guidance for the quarter and for the year. And look at what the stock did. It gapped up. So, again, I think that this is a group that's been oversold. I think is starting to show some signs that it wants to go higher. And despite the warning that Wyndham just came out with, look at the volume trend starting to turn more positive. I think this is one, as long as it holds that 20-day moving average, that probably goes up higher, although I do like Hilton better because of the technical strength, the relative strength. ACCO warned ACCO, stock gap down quite a bit, has rallied back, nearly filled the gap, now starting to weaken again. Can it get above that 20-day moving average? I don't know. And just two more real quick. Teva Pharmaceuticals, big gap down here. You can see with its warning, came back up. Prior support level was about 18.20 or so. We got up to 18.15, now starting to go back down. And the last one, talk about throwing the baby out with the bathwater. Well, here's baby going right out with the bathwater today with the lowering the guidance. Stock gaps down well below the October low. Look at the volume that's been coming into this stock before the earnings came out and before the lowered guidance. So stock definitely not looking very good. Let's get a quick summary of what we just talked about on our spotlight stocks. I know we went through a bunch of them pretty quickly. And then we'll bring up the poll. An interesting poll today because of a special guest that we have coming on tomorrow. Hopefully he had a chance to answer that.
And he did some work for me as far as the workshop I have to plan Tuesday. I'll probably cover what he doesn't have to cover.
Well, here's the deal. So Bill Shelby's joining us for Valentine's Day tomorrow, and he was going to go over whatever you all voted for. And so here's the list. We've got popular oscillators, modifying predefined scans, chart list management, miscellaneous tools, explaining annotations, and configuring the dashboard. And 35% of you went with popular oscillators. Did you vote, Erin?
I did, and I went with miscellaneous tools and configuring the dashboard because I just, I'm pretty familiar with the other parts. There's probably stuff I've missed, so that would be why I voted for those.
Aha. All right, well, I did not vote, but I'm going to cast a verbal vote right now, and I am going to go with, I'm always with the minority. But I'm going to go with miscellaneous tools just because I have no idea what's in there.
Right.
It's like potluck.
Exactly. So I agree. But popular oscillators, I'll tell you what, guys, whatever he doesn't cover on those oscillators, I'm going to be taking notes. And like I said, whatever he doesn't cover here on this list, I'm going to just, bogart, as they say, and take them for my workshop.
I'm going to piggyback right on top of Bill.
Yes.
Well, there you have it. We are getting close to the end here. I do want to just quickly give everybody an update on the market before we leave. Got the Dow Jones Industrial Average currently up 92. It is trying to bounce back a little bit off those lows, intraday lows that we just saw. NASDAQ up 17, the S&P 500 up 8, and the Russell 2000 up 2 points today. So everything in the green right now as we bring the show to a close. Excellent. All right. I want to thank all of you for being with us today. A special thank you to Rick Bensignor for joining us. Fascinating presentation. Might want to go back and rewatch that one later. Please remember to complete the survey as you exit. It's located below the video player. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. We'll see you back here tomorrow. Happy trading.